Welcome back, everyone. My name is Adam. Rusmin.
Hello.
Victor.
Hi, everyone.
Thanks for joining us. Today, we're going to do a portfolio review. So we haven't done this for some time, and I thought it'd be a good time to do another one. So a lot of feedback from you guys who are watching this saying that you like the portfolio reviews because it's like real life portfolios from real people. They submit the portfolios to us anonymously. So it's all real portfolios, real money. And then we kind of like give our feedback and opinions on certain things about how the portfolio could be optimized and also the stuff that they're doing well. All right, so today we have someone, his name is SG Investor. So I don't know who this guy is. He is 60 this year, retired 2 years ago, married with 2 kids. Kids are already grown up and working. Home is fully paid off, and he has a portfolio of 2.5 million.
Yep.
All right, so it's pretty
Including
sizable.
cash.
Including his cash and CPF OA. So quite a good sum to retire. And he's asking whether, this is basically good enough for his retirement. So he likes investing in Singapore stocks. Maybe he's looking at some US positions as well, and we'll talk about that. And he's a little bit risk averse. He's saying that he prefers a return of about 5-6% per annum, beat inflation. So we want to have a look at his portfolio and see whether it makes sense for him and whether he should actually go into the US for him. All right. So why don't we just give a quick overview of his portfolio at this time?
So I think I didn't even want to tabulate his table because he tabulated it until so beautiful. I just beautify the thing a bit. Right. So I look at the way he present the template. I already know this. I think he's very clear of what he want to do. And he sized his position very well. I mean, no sectors are all the maximum for one sector is about, I would say that stay at 30% so that you are well diversified. So some of his sectors are slightly just above 30%, maybe 30 something or so, which you can see allocation by cost, right? Initially, the finance sector was 20%. General was like the mix of any different sectors. It's about 31%. REITs about 8%. Cash is about 36%. But throughout the years, I think the portfolio have grown. So now the finance sector is about 34%, which is all the banks. Okay, and he also mentioned that he trimmed down his DBS. So I believe previously was actually quite high in terms of the allocation. General is still 27%, REITs is 10%, and cash is about 29%. So I think in terms of just overly look the portfolio, I think his portfolio allocation is good, right? Very well balanced and all this.
That kind of gives him passive income of like 85,000 to 90,000 a year.
Yeah, pretty good.
So so that's a month is about 7,000. Right, so that's actually very good dividend. Right, if he's, I think he retired, so probably he's more than enough to cover his expenses.
Home fully paid off. Don't have to worry about mortgage. Living the life, man.
And enjoy his retirement and watching this video.
So I think let's talk about his bigger position, which is the banks. He bought DBS, OCBC, and UOB. I think DBS he bought even before, I think the COVID or something like that. So he had been holding for a long time, and he trimmed down his position recently, but it's still become a sizable, sort of like become the carry of the whole portfolio. Right. So I think he have trimmed down the position. I think all the price that I look at him buying the banks are quite a good price for him. So I think there's not much issue for his bank. I think he got mentioned like should he continue to trim down his bank position like we mentioned in the previous video, is you also have to compare with the 10 years SGS and right now I think if you look in terms of the bank, it still don't make sense to sell the bank right now, because if you sell the bank, then where can you put the money?
So I think I calculated his yield on cost for the DBS. His yield on cost is actually about 10%. OCBC is about 6.2%. UOB is about 8.3%. And the reason why he can get it at such a high yield on cost because I think he bought it during the right time, which is probably during COVID or 2020, 2021, that era, right? OCBC, he probably bought it at a later part, okay? And that's why his yield on cost is slightly lower at 6.2%. But it's pretty good, right? The timing of entry, I think it's perfect.
And you were saying you feel that it's not time to let go of the banks even. But what if the allocation in this portfolio just grows tw big? What would you do? Would you rebalance it?
I think he's concerned because the portfolio he actually rebalanced his DBS.
Yeah.
That's
Okay.
why I saying that the allocation in terms of market value was 34% for finance. But I think it's higher previously.
Okay.
I think you can do that if you have a concern, but generally I don't do that.
Okay.
I base on valuation and I do my selling or any fundamental issue with the company.
Okay.
Yeah, so right now I think DBS is the largest contribution, right? At about 23% of the market value of the whole portfolio value based on market. I actually think that maybe this one he can continue to pare down, given that I think DBS is the highest in terms of valuation among the three, right?
Yeah. So I think he was saying that he's scared that he cut, or kill the golden goose, right? At the end of the day is if your golden goose get too fat, right, and very, very, very fat until it requires the golden goose to lose weight, right? That's you should sell before it start going for.
So you feel the
weight.
DBS is not that fat?
Yeah, it's not that fat yet, right? It's not that fat until you cannot walk.
Okay, so still fine.
Yeah.
Okay, so that's your opinion.
Yeah, correct. If you get too fat until you cannot walk, right, then you make sure you start cutting some fats away. Yeah.
I think so fat already.
Okay.
23% to me, for me is a little bit
So that's for
heavy.
you.
Yeah, so for me I will continue to pare down,
Yeah.
given that now everybody like banks so much, and valuation is also on the higher as compared to the other two banks. Or maybe I will just size it. I think put some to OCBC and UOB instead, since their valuations are slightly cheaper, right?
Yeah.
Okay.
But
If
my
not-
fat is based on valuation, not based on the portfolio calculation.
Correct.
Yeah.
So if not, I will maybe because to me concentration of a stock, if it's take too high, whether how good they are, I will pare it down a little bit.
Okay.
Right? So I will probably take it down and then put it on as a cash. But if he say he doesn't need that passive income, his ERS can actually cover his basic, right? So he doesn't really need it. So I think he has a time to wait out for probably the next crisis. So he will have like more cash. If he
But anyway, he
pare down.
trimmed already.
Okay.
Yeah,
He start cutting some.
which is good.
He made the goose lose some weights.
Okay. So anyway, not recommending you to buy or sell anything. So if actually investor you're watching this, we're not giving you any advice. Anyone who's watching this, we're also not giving you any advice. But this is how you would manage an oversized position in your portfolio. For you would like to trim it. For you, just based on pure valuations.
Yes, correct.
Even if it's a bit of an outsized allocation, if it's not too overvalued, you'll keep the golden goose running along.
Until you cannot walk. Then you start cutting the
Because
fats.
I always think that I think the interest rate very hard to predict where it's going, because the next moment when the crisis comes, the rate can just fall overnight and all the bank will just
like lose some.
you'll lose. Yeah, you're definitely correct.
I think you are concerned about that if you bought at a slightly higher price, right? Because the price he bought was quite a good price. But if you bought at slightly higher price, then there's a chance that when the thing switch, it may goes below the share price. But his one, I think, he's bought in a very, very good price actually.
Would it matter if he's a purely an income investor and just based on dividends, you just
you can
hold
just
on to
ride through the cycle. There's no problem on that.
Yeah, you can just ride through the cycle.
I think he's I mean, throughout the years, he said he's hitting about 8. Let me see. Over here,
8-9%, yeah.
8-9%. I think.
8-9%,
yeah.
Right,
Yeah.
decent. He's very clear. He's not going for the gains, but he's going for his risk adverse, and he's going for the decent return. So he's actually aiming for 5 to 6% actually. But throughout the years, he has been average gain plus dividends about 8 to 9%, which surpasses his thing, right? So I think let's say you were to ride through the bank cycle and you don't sell a bank, you just collect your dividend. I think he can easily hit your 8-9%.
Okay.
Yeah, and just doing nothing only.
Okay.
Yeah.
All right. So let's move on from the banks. So since we're on topic of interest rates, what about the REITs?
So I think right now, obviously REITs are oversold, right? And the best time to buy bank is when the rate at all time low or when there's a crisis, and that was the thing in 2020. And the best time to buy REIT is when the rate is all time high, or
on the
coming
high
down
side.
on the high side, right? And now risk actually is beaten down, so I think it's really like the right time for him to increase his percentage of his REIT allocation, because right now, based on his portfolio, based on cost allocation, he only managed to allocate like 17%. I thought that he could have like switched some of the banks that he currently holding to REITs, given that the valuation is a lot more attractive as compared to the bank.
So what do you think of his 3 current positions in the REITs that he has? A-REIT, Escort, CICT.
Yeah, so I think right now the valuation for all these 3 REITs are probably on the lower side, which is a good time to, for me personally, it's a good time to accumulate, right? So CICT I think is quite a decent REIT, and then Ascendant Industrial, of course they have their own problem with their business park. Some of the sector is actually oversupplied, but generally it's actually considered quite a well managed REIT also. On the other hand, for Escort, I think this REIT actually has exposure in the hospitality segment. And I think if you look at their portfolio, they own, I think, close to like 100 properties, hotels, service residences, even student accom, right, around the world, right? So it's really very diversified, right? And if you look at like the percentage of the longer term stay accommodation that I think under Ascott portfolio, those are actually provide a more secure or stable income. Okay, and the other 46% they do have a master lease on this segment, which also gives them like at least some form of base income, but they do earn variable income from some of these service residences and likewise for the hotel, right? So whenever there's a crisis or there's a pandemic like what we saw in the 2020, the income from these REITs might fall. Okay, and I think if it's like planning to buy into this dividend stock, I personally would not like to invest into some of these cyclical stocks, right? So to me, hospitality sector is considered a cyclical stock because during the pandemic, I think occupancy or even tourist arrival hit all-time low. And barely, I think it dries up right overnight for tourist arrival for Singapore and a lot of countries, right? So that actually hit Ascott portfolio, right? But thankfully, they are like considered one of the better one among the hospitality REITs because they still have like long-term stay and also the service apartment. They have some form of master leases, right? So, but generally, I think Ascott, unless he bought it during COVID, right, which is a time where there's no tourist arrival, occupancy at all-time low, share prices plunging, that is actually one of the best time to buy. But right now, I don't think it's considered a good timing. And I would prefer something that is a lot more stable. For example, like data center, okay, which has a very good outlook, all right, and the vacancy in a lot of our countries are actually also very healthy, right? So I will personally switch it out. And again, this is the right time for him. I think personally, if I were him, I would beat up the REITs component, the percentage, okay? Because at different time of investment market, right, there will be opportunity that will appear. Some will become expensive, some will become cheaper, right? So this is a case where I think REITs is fall under.
So you'll beef up the REITs, but you would not hold on to Ascott REIT.
Yeah, I would not hold on to that.
Because of the cyclical nature of it. You don't really like it. It's less predictable, less stable.
Yes.
There's some of the other kind of REITs out there.
I mean, you can still get into this kind of REITs, but you got to get in at, I always think that at the right timing.
Okay.
Right, yeah. But right now, I think even with a full recovery of like the occupancy across the hotel, I mean, if you look at the DPU, it's still below pre-pandemic, right? And I didn't have the impression of Ascott because I still remember, I think before COVID, when I attended the AGM, they were very focused on growing the AUM, right? And I look at the DPU was like falling, and that was the end of my journey with Ascott. But now there's a change of management. It seems that I think the newer management focus a lot more on DPU, but I don't know. It's still a sector that I would personally try to avoid.
I mean, you have more other sectors that you prefer.
I prefer, within the REIT segment.
Okay. Yeah. So that's for REITs. What about the other? And he has an entirely Singapore portfolio. If you're wondering, what about the other Singapore stocks that he has? Anything that stands out you want to talk about?
Yeah, I think the next one I look at is the Jardine CNC, the cycle and carriage, right? So that's the automotive business, and it's generally I think more cyclical in nature. So if you look at the earnings before tax exclude exceptional items, you can see from here in US dollar they have right from 2014 and to 2024, right, is the earnings are quite volatile, right? If you look at the dividends over here, the regular dividends also like up and down and up and over here. But if another alternative I feel is instead of owning CNC, right, you should consider Jardine Matheson. Because after all, right, Jardine Matheson owns about 78% of CNC. So owning Matheson is owning CNC, and on top of that, you have other business over there, right? So if you look in terms of Matheson business, right, it's also exclude exceptional items, also like sort of like up and down, which is quite similar to Jardine CNC. But on top of that, right, the regular dividend is much more stable as compared to CNC. As you can see, the regular dividends are consistently increasing, right? But if you compare the dividend yield between the CNC and Matheson, right? CNC is like giving you about 4.32% dividend, but Matheson is like 5.63% dividend, right? So you look at the share price movement of both of them, right? The Matheson tend to be more resilient compared to they tend to move in tandem, but the Matheson tend to sometimes edge above the CNC. So actually owning Matheson, owning CNC is roughly the same, but you got a more predictable dividend and you got much higher yield.
Oh, that makes sense. Yeah, so you can like switch out the
Yeah,
position
just
and
switch out. I think that's the thing I would look at the Jardine Matheson.
Could it be the reason why he has CNC is because he drives a Mercedes?
probably. Yeah.
And Jardine CNC, I think, very heavily tilted towards Indonesian market. So I think that rupiah depreciation over the long term against Sing dollar, I think is going to be a continued headwinds for the company.
So
but generally, the company is still quite solid. I think
the Matheson is more conglomerate.
Yeah, Jardine Matheson is a lot more diversified.
Okay, some people don't like a conglomerate because it's usually they don't value so well. But in this case, more stable dividends, higher yield.
Correct.
Kind of makes sense.
The performance tend to move in tandem.
Okay.
And sometimes they edge up against the CNC. So 5.63%, he's looking for 5 to 6%. Easily hit his criteria.
Okay.
And to me, the right valuation is very important. Right? I mean, we talk about it. If Jardine Matheson is really on the high side, then obviously we wouldn't even bring it up. Yeah, but right now I think both are quite depressed in that sense. Yeah.
All right. So what about the rest of?
If I were to look at Sheng Siong, I think the price he paid at 154 based on the dividend is about 4%, 4.1, 4% like that. I think he just paying slightly above the fair value. Okay, but personally for me, right, I won't buy Sheng Siong at this price. Right, because I feel Sheng Siong growth are limited. They are only within Singapore. Right, they are not just expanding to the rest of the HDB. And how big is Singapore?
What about the China business?
Yeah, I don't bet on that, right?
Okay.
Because Chinese is very competitive, right? And they are just testing, but it haven't contributed significant to the thing. So that is just a dream.
Okay.
Right. Until you contribute 10% and still growing very fast, then I may look at it. But at this moment, no.
It's purely a Singapore business.
I still feel it's a purely Singapore business. But it's very stable. Right. So for me, I won't do that. But for him, if you want to hit his 5 to 6% at 4% yield, and assuming that supermarket business can grow, which likely grows with inflation about 2.53, I think he hits his 5 to 6% growth.
Okay, all right.
Yeah, so I think it's still decent for him.
So Sheng Siong as a stock kind of like fits his criteria.
Yeah, but it's not. But the price is not like overly expensive. It's just decent.
Okay.
Yeah.
All right.
Yeah.
And then the other one I want to talk is Singapore Airlines, right? So I personally like to take Singapore Airlines. Right, its service is better as compared to other regional airlines, right? But as an investor, I would not touch Singapore Airlines.
Why is that?
Okay, I think if you're investing in Singapore Airlines for dividend, this is probably the wrong stock to look at, right? Because airline, I think we all agree that it's really a cyclical business.
Yeah.
And if you look at the past dividend, I think the result kind of tells you everything, right? So during like 2001, 2002, and there was a SARS, and then there's also a bit of a crisis, right? And the dividend just dropped. And then when the economy picks up, of course the dividend also picks up. But then when the crisis came 0809, the dividend got cut again. And yeah, so you can see that there are multiple dividend cut over the past 20 over years, right? And COVID was probably the worst, all right? And if you bought during COVID for that recovery play and the capital gain, yeah, that's fine. But if you're just investing it for dividend, I think it's not the right dividend stock to pick.
Okay, I mean, it's not really a dividend stock per se.
Yeah, it's not.
It's giving him a decent...
I mean, it pays the dividend, but...
Yeah, but even the Singapore Airline, they have the engineering business inside. It's also going on a downtrend.
It's a tough business,
right? Because the industry a bit disrupted already. Which right now the Rolls-Royce, they are doing their own MRO and all this, right? So I think we need to differentiate. Sometimes some business are very essential for the country one, like SIA. It's very essential. It brings traffic to Singapore. It brings people.
There's economic activity.
It's very good. But it's very essential and it required by the country. But it may not be a good investment. Right? You must see good essential business and investment is two different things. You need to really separate it, right? For SIA, I feel it's really essential.
But sometimes there are some essential businesses which are
also good investments.
Good investments, but not in this case.
But not in this case. Not in this case. Okay.
Yeah.
Right. So you need to really know how to differentiate on this part.
And the reason why is because it's just such a cyclical business. Very volatile because of I mean the
correct.
So affected by fuel prices.
Yes, correct.
For example.
Yeah. So when you want to, let's say, invest in this kind of companies, cyclical companies, like you should not have a long-term mindset. You should have a much short-term trade mindset, right? That means if you really get very bad situation, right, the stock is beaten down, you go in for the short term when the recovery comes and you just
He's going
sell it
to
off.
like basically play with
Yes,
the cycle,
correct.
right?
Yeah. So that is, I think, is for this type of companies like SIA.
Yeah.
Okay.
Just like COVID, right? 2020 when they got hit, the share price was like tank. But you know, at that time there were other better stocks.
Yeah,
also.
correct.
Yeah, that's true.
So at the end, that's why I never get my hand on Singapore Airlines.
Okay.
Yeah.
Yeah.
All right. So anything else you want to share about the rest of his Singapore
I think he
holdings?
got Singtel about 381. That I don't think. I think he bought many years back, lah. So the price is. I mean, if you have been following us since 2014 and now, we have always been the advocate of like don't invest in telco. The industry is getting very intense, right? I mean, we talk about it very openly about the telco. But of course, in recent years, there's the industry start to consolidate, not in Singapore, but the overseas. So Singtel overseas, all those telco they own, right? The industry start to consolidate and become less player. But Singapore is still very intense.
Singapore telco is gone.
Yeah. So I think Singtel generally still okay. They are on a recovery plan right now.
You can't say that. We had the Singtel CFO here, man.
I can share with you what I just did with my personal plan, right? So I had with StarHub, I was paying like 30 plus, and then SIM only plan. And I recently switched to 8. And that actually cost me $8. And I come with the roaming data, local data.
Oh, roaming data.
Roaming data. I don't have to pay overseas roaming charges anymore, right? With the gig that they give me, which is enough for me to last in there. And I only pay like $8 flat a month.
Wow.
Time to switch.
Yeah, I think the CFO did acknowledge, right? The Singtel CFO did acknowledge that Singapore is a tough market.
Yeah.
It's a very tough market,
It's gone.
right?
It's gone.
Yeah.
No,
they haven't consolidated yet.
he didn't say that. He said this is still our home market.
Yeah.
Home market.
They are very focused on it.
Yeah.
But it's competitive, he said.
Yeah, correct.
Yeah.
So the other markets are generally other markets are generally better now. All right.
Okay.
So now their main focus is more like data center,
Okay.
converting to asset light and all this. So I think it's quite promising for Singtel moving forward.
Okay.
So I think even though he buy a slightly higher price, I think if you hold on to it, I think we may bear some fruits from there. But of course your returns may not be as good because he bought at a higher price.
Okay.
Right.
Oh,
Yeah.
StarHub is still listed.
Yes, it
Yeah.
is.
Oh.
Yeah.
And I think now there's some
Gone.
rumors of trying to merger or something like that. Yeah.
Gone.
Okay. No, you can tell you're not a big fan of the
man.
telco industry. Okay, so let's move on. So the thing about his portfolio is that he has a lot of cash actually. I mean a sizable amount. 200,000 in cash and 500,000 is CPF OA, which can be used for investments as well in certain stocks and funds.
Yep.
So he did mention that he was looking at possibly investing in the US through ETFs. So instead of picking stocks, he could buy an ETF,
Yep.
giving exposure to the US. What do you think about that sort of move for someone who is 60, enjoying retirement? Should he go into something like an ETF?
Yeah, I think he
for the
also
US.
did mention that he wanted to buy into the S&P 500 ETF.
Yeah.
Just that he's concerned with the valuation.
Yeah.
Okay, I think that is a good start because the thing about investing in index, right? There's periods where the S&P 500 is down for almost, I think,
10 years.
10 years
Yeah.
or maybe more than that.
Yeah.
Right. So if you buy at the wrong timing, it does kills you for your flat
Yeah, it's
flat
flat
return,
for like
flat
10
returns
years. Yeah.
for your
Yeah.
or maybe negative until it recovers
Yeah,
back to your break-even points for your US market if you bought in 1999 peak or 2000 peak.
Yeah.
Right. So I think he knows that, and I think if you want to really buy into ETF, you really have to time this the first thing because you're 60 now, right? Your time period, you don't know what's the time period.
Yeah.
Yeah, and on top of that, invest in the US. Do take note, you must go to the Irish domicile and don't go to the US domicile because you're going to have inheritance tax and all this. So, but I think his Singapore portfolios are doing quite decently well. I mean, majority he picks okay. Just sometimes he pay at the wrong price. It's still okay, right? I think if he continue doing his Singapore portfolio, I think I feel moving forward, Singapore portfolios tend to do better, like we mentioned down there, because a lot of the Singapore companies are turning into asset light. So there's a focus on the change in terms of the business model. So I think, which I mentioned at that time, even though Singapore is fair value, I feel the value should go up because they go and turn into asset light. So I think if he continue to focus in the home market, I think it makes more sense for his retirement than investing in the overseas that you will get exposed to forex.
Yeah.
Yeah.
I mean, for him, someone like that, Singapore seems like a really good market for him to invest. Very nice, decent, stable dividends, hits his goals. And the other thing about investing in the US, I mean, now we can do another video about Trump and what he's doing. The market has been coming down recently because of all the tariffs and stuff like that. But I mean, a lot of people who think about the US market nowadays, I mean, if you're someone younger, you think about, okay, I'm going to invest in the US, I'm going to DCA in like the VWRA or the S&P 500 for the next 10, 20 years. It doesn't make sense for someone like this because we don't know. We always assume the market is going to go up, but this is over a long-term horizon. For someone like him, like you said, if you put it now, maybe for 10 years it's flat. Or he could lose money. So, but what should you do with the cash in the meantime? Would you just let it sit there? Or would you, like, for example, maybe wait till like the US really hits a major recession because like you don't know what's going to happen, and then maybe you could deploy it then? How would you do that?
I'll do that, but I mean, I look at him, he put it mainly in SSB, T-bills and all this. I think he do a good job while sitting on and wait and all this. But you should put more in short terms bonds and all this that you can take back immediately. If there's a crisis, then you can take opportunity. I think he's doing it right while waiting for opportunity.
So you think his 30% allocation in like cash and CPF,
I think it's okay.
It's okay at this point?
It's okay, And his cash his CPF is still 2.5, right? And he put in SSB and all this is also higher than 2.5 lah. I mean, like around 3% or something like. Oh no, 2.8 now.
So if you were 60 years old and you had this amount of cash, you would wait for an opportunity, possibly in US market?
Because you got,
even if you're 60,
you got not enough time to make mistakes. You need to be very careful in every deployment, right? So just be very careful, I feel.
I think he's been very careful actually when he crafted this portfolio. But it looks like a STI index to me.
But it's done well though. It's done well.
It's done well.
It's done well.
Pick the correct one.
Okay. Yeah, that makes sense. I mean, it does look like the STI.
I didn't notice it.
So we were talking about STI ETF.
But he said he don't want to invest in STI ETF.
Yeah, good. But he's done it for himself in a very successful way.
He picked a better one.
So I mean, some people will kind of like they're not fans of STI, but this guy has done his own mini STI.
STI, yes.
And he's done well for himself. Okay, so I think that is the review of our portfolios. Anything else you want to share about his positions? Anything else?
I just enjoy his retirement. Watch this roundtable with the popcorn.
I mean, it's quite secure, right? His wife and his ERS is like 4 times, right? So the basic needs plus a bit of holidays, I think all can covered by the ERS.
So he's got CPF and he's got CPF ERS plus
4 times with he and his wife,
and plus his dividends. He's pretty much
secure, and house is fully paid.
And there's a condo.
That's all. I mean, if he downgrade from his condo, he got extra cash.
Provided the kids doesn't need any money from them.
Kids are working, so he mentioned it. So it should be all right. So he's done well.
Very good.
He or she has done well. Actually, I don't know.
I believe this is not started now. I mean, he probably planned it for years. And that's why he's bearing the fruits now.
Past 15 years.
15 years. Actually, that's not too long, actually.
2010.
So actually, you don't need super a lot of time, but you do need to like save, invest properly over a period of time. And he's managed this for himself. Okay, so how would you rate this portfolio? How would you give it?
So again, back to the criteria. So how will you give a portfolio is like, first, the quality of the company, like paying at the right price, and does the portfolio congruent with the objective that he set for himself? So I think in terms of the objective that set himself and capital allocation in terms of well spread, I think he do it very, very well. I think some of the companies he bought are quite quality, but some are not, right? So that may not be a top, and some of the price he did not pay very well. But the bank's price, I think he paid generally quite well and all this. Right?
You must have watched our roundtable.
So I think in general, I will give him like, I don't think it will goes to an A, but maybe usually I say B plus lah. I'll give him a B plus.
Okay. So it's like close to an A.
Close to A, but
close
not,
to an A.
Not right.
Okay.
I'll give him an A because he has got good capital there. Right? So enough for retirement. So that's an A portfolio.
That's true. Because
even if he choose not to do anything, I think his current portfolio will.
I think that's a good point because he could do this really well, but if your portfolio is like 100,000,
correct,
that doesn't really help your retirement.
Yes.
So you have a good portfolio, but he has the size for it. 2.5 million, good enough for retirement.
So I think 100% he is objective.
Okay,
right. So very few you can see people set the objective and fulfill. Most people, they will set the objective, but they deviate from it. Right? He's very clear of his objective, so that I really have to give it to him.
Okay.
Yeah.
All right. So with that, I think that's pretty much what you're going to share, the reviews.
Yeah.
Okay. So SG Investor, whoever you are, if you're watching this, we hope this was really helpful. Again, no recommendation to buy. So anything is just purely our opinions.
Yep, correct.
It's just there's no advice here. Anyone who's watching this, same thing as well.
Yeah.
Yeah.
And also, if you guys have any portfolio you want us to review, you can just send in to the
just email us, and then if it's something that's interesting, we will select it and we will let you know. So we do get a lot of submissions, and we apologize if we don't select your portfolio because there are really too many.
Yeah, correct.
And we can't do portfolio reviews all the time. So as and when we'll pick one that kind of makes sense.
Yeah, that we find very interesting.
Yeah. So in this one, this guy is a retiree. I don't think we've done a retiree yet, right?
Yes,
Not
this
yet,
is the first time.
So this is the first one. So I hope that was useful for you, especially if you're nearing that age and what you could do as well. So any questions, put them in the comment section. We'll be happy to answer them. Anything else, guys?
Enjoy your retirement.
Enjoy them. Yeah. All right. Many years to go, right? 60 to 85, 25 years.
25, at least 30s.
Yeah, 30 years
30
maybe.
years,
Okay.
yeah.
So my name is Adam, Rusmin, Victor.
you.
Thanks
Thank
for
you.
watching. Again, any questions, comment section. If you like this roundtable, please hit the like button. Of course, subscribe. We'll see you again.